Hello everyone and welcome. Today, we're diving into the world of financial ratios, powerful tools that investors use to evaluate the health and performance of companies in the stock market. Whether you're new to investing or looking to refine your analytical skills, understanding these ratios is crucial. Let's explore the key financial ratios, their calculations, and real-world examples to illustrate their use. First up is the price-to-earnings ratio, or PE ratio. This ratio measures a company's current share price relative to its per-share earnings. It's calculated as PE ratio, equals to share price upon earnings per share, EPS. For example, let's take Tata Consultancy Services, or TCS. Suppose TCS's share price is 3,200 rupees and its EPS is 160 rupees. The PE ratio would be 3,200 upon 160 equals to 20. This means investors are willing to pay 20 rupees for every 1 rupee of earnings. A PE ratio of 20 might suggest that TCS is fairly valued compared to its earnings, but it should be compared with industry peers like Infosys or Wipro for context. Next is the price-to-book ratio, or PB ratio. This ratio compares a company's market value to its book value. It's calculated as PB ratio, equals to share price upon book value per share. Let's consider State Bank of India, or SBI. Suppose SBI's share price is 600 rupees and its book value per share is 400 rupees. The PB ratio would be 600 upon 400 equals to 1.5. This indicates that the stock is trading at 1.5 times its book value. A PB ratio of 1.5 might suggest that investors expect some growth potential or that SBI's assets are valued higher in the market. Return on equity, or ROE. The return on equity measures a company's profitability relative to shareholders' equity. It's calculated as ROE equals to net income upon shareholders' equity. For instance, if Reliance Industries has a net income of 90,000 crore rupees and shareholders' equity of 450,000 crore rupees, the ROE would be ROE 90,000 upon 450,000 equals to 0.20 or 20%. An ROE of 20% means Reliance generates a 20% return on the equity invested by shareholders. This indicates effective use of equity to generate profits. Debt to equity, or DE ratio. Now let's look at the debt to equity ratio. This ratio compares a company's total liabilities to its shareholders' equity. It's calculated as DE ratio equals to total liabilities upon shareholders' equity. For example, if Adani Enterprises has total liabilities of 70,000 crore rupees and shareholders' equity of 30,000 crore rupees, the DE ratio would be 70,000 upon 30,000 equals to 2.33. A DE ratio of 2.33 means the company has 2 rupees and 33 paise of debt for every 1 rupee of equity. A higher ratio indicates significant financial leverage, which could be risky if not managed properly. Finally, we have the current ratio, which measures a company's ability to cover its short-term liabilities with its short-term assets. It's calculated as current ratio equals to current assets upon current liabilities. Let's take HDFC Bank. Suppose HDFC Bank has current assets of 1,20,000 crore rupees and current liabilities of 90,000 crore rupees. The current ratio would be 1 to 20,000 upon 90,000 equals to 1.33. A current ratio of 1.33 means the bank has 1 rupee and 33 paise in assets for every 1 rupee of liabilities, indicating a healthy ability to meet short-term obligations. Understanding these financial ratios provides valuable insights into a company's performance and financial stability. They help investors make informed decisions by evaluating aspects like valuation, profitability, risk, and liquidity. By incorporating these ratios into your analysis, you can better assess whether a stock fits your investment strategy. Thank you for joining us today. If you have any questions or need further clarification on any of these ratios, feel free to ask. Happy investing. Thank you for joining.